Rewards are one of those interesting ones. So like a 1-to-1 risk reward ratio, 1-to-2 risk reward ratio, 1-to-50 risk reward ratio. Here's the way I do it. Let's say I'm taking a resistance trade, right? Price comes into a resistance zone on the daily or the 4-hour time frame. And then what I'll do is I'll enter a trade, generally speaking, at that zone, put a stop loss above the zone, and then a target has to go somewhere below. You can't hold the trade forever. You have to figure out like an ideal location to get out at. So the way I approach it is, let's say that there's a resistance zone here. Generally, price is going to be making higher lows as it's coming up into that resistance zone. What I'll do is whenever I sell at that zone, put my stop above, I'll look at where one of the recent lows are, and I generally won't target past that. So some of these trades, it'll be like a 1-to-1 risk reward ratio, 1-to-1.5, sometimes a 1-to-2, and in some cases even more than that. But what I'll do is I'll get the trade started. It'll generally start at around a 1-to-1 risk reward ratio. And then if I see that price has a lot of momentum and it looks like it's going pretty quick towards the target, in some cases I might extend it, but I generally won't target past one of those recent higher lows. Now this obviously depends on a lot of the context and stuff like that, but you kind of have to take quote unquote what the market gives you. So if you notice that price is really channeling up into a resistance zone, you can't be targeting like something like insane, right? Trying to get like a 1-to-10 risk reward ratio on it. You can, and they'll hit every now and then, but you're gonna have a lot of break evens and a lot of stop outs and a lot of trades that go into huge profit, then come all the way back. Using 1-to-1 risk reward ratios are great because they teach traders what it is like to have just a 50% win rate, buying and selling randomly with a 1-to-1 risk reward ratio. Your stop will get hit half the time and your target will get hit half the time. Then what you do is whenever you have those trades that start to play out after you enter, you can then elect to close them a little bit earlier if they look like they're going to hit the stop loss, right? So you could take a small loss or take a break even, or in some cases even a small profit, and then you can close them dynamically based on if they're going into profit and they start to slow down and starts going sideways. You can make these little context-based nuanced decisions that come from your intuition, your discretion, your price action discernment. So there's no best or right or wrong risk to reward ratio. It all comes down to the context, and you only get that context with experience. So I just recommend starting with a 1-to-1 risk reward ratio. And if you start with a 1-to-1 risk reward ratio, that'll teach you the mechanics of how trades go into profit, go into loss, and it'll teach you how to manage trades that start to not work out. So that way you can get out of those trades a little bit earlier and then hold your winning trades a little bit longer. Then you'll be making more on your winners than you lose on your losers. And even with a 50% win rate, if your average win is say 50% to 2 times what it is you're losing on average, that's a profitable approach. You're making more when you're right versus what you lose when you're wrong, regardless of what the risk to reward ratio is. Start with 1-to-1, maybe work on extending it to 1-to-1.5 and 1-to-2 after you get a little bit more experience. And then you can start to be able to trade in such a way that you're profitable, making more money than you lose long term.